Today we're talking about 3 stocks to buy in March 2018. Stay tuned. Welcome back to Whiteboard Finance. My name is Marko and I'm here to help you master your money and build your wealth. Today we're talking about 3 stocks to buy in 2018, but if you haven't subscribed already to my channel, please do so below. We talk about personal finance, stock market investing, entrepreneurship, and real estate investing as well. So let's get right into it. I'm going to start with number 1. Number 1 is CVS. So CVS is the largest pharmacy operator in the United States, and it has increasingly turned its locations into small general stores. I'm sure most of the people watching this video have been in a CVS and they know what I'm talking about. CVS also operates a large pharmacy benefits business that serves more than 1 million customers profitably, and they also provide Medicare D prescription drug plans as well. CVS is now trying to add another arm onto its business, and that's the reason why they're making the list of 3 stocks to buy in March of 2018. So the pharmacy agreed to a $69 billion buyout deal with Aetna. So Aetna is the number 3 health insurance provider in the United States, and this happened in late 2017, which I'm sure some of you are aware of. So the belief is that CVS is trying to fend off Amazon, which appears to be poised into getting into several healthcare industries via different initiatives, and I think pharmacy and pharmaceutical drugs being one of them. The merger between Aetna and CVS is to result in $750 million in annual revenue and cost benefits by year 2. This will obviously help both companies out mutually, which is the reason for the merger. The company's core pharmacy business, CVS's that is, tends to keep churning in good times and bad, which has helped keep profits steady enough to fund a dividend since 1993. That's about 24 and a half years now, you guys. That's an incredible track record of raising dividends. So the dividend payout has increased every year since 2004, which is great, and the dividend yield is right around 2.9%. To wrap things up, the 1-year return on CVS has been about negative 16.28%, and out of all my stock picks up until now, I've never recommended a company that's had a loss over the last year, but I think this could actually be a buying opportunity. Let me know in the comments below if you agree or not. Number 2, Las Vegas Sands. Las Vegas Sands is a well-known owner and operator of casinos in the United States, but it also owns and operates casinos in Singapore and in the Chinese province of Macau. If you don't know the history of Macau, look it up. I think it's pretty cool. It has a lot to do with old Portuguese settlers, and I know that has nothing to do with investing, but I also enjoy history. So check out the history of Macau when you have a chance. So Las Vegas Sands has just recently increased its quarterly dividend, which actually adds up to about $3 annually. So this comes to a yield of just over 4%, and that's more than twice the average of the S&P 500, which is an excellent dividend yield. So this came alongside a September quarter earnings report that saw profits grow 11% per share, which is awesome. Their Macau operations posted its best quarter since 2004, with adjusted EBITDA reaching $652 million. If you don't know what EBITDA is, that stands for earnings before interest, taxes, depreciation, and amortization. Prospects in China look even better after a February 1st report showing that Macau gaming revenue jumped 36% year over year since January of last year. This is its best improvement in 4 years. So this could mean that Las Vegas Sands earnings could grow more than 7% than the analysts currently expect for 2018, and that's the reason why it's on this list right now. So meanwhile, analysts at Morgan Stanley say strong growth in Macau and Singapore could provide additional cash flow and provide a catalyst to increase the dividend even further than it already is. If you remember, the dividend right now is right around 4%, and the 1-year ROI for Las Vegas Sands has been right around 42.5%, which is excellent. Number 3, okay, I'm not even going there. Number 3 is McDonald's. McDonald's has over 37,000 fast food chains on the planet, and it's one of the most well-known fast food chains on the planet, which I'm sure 99.9% of my viewers have probably heard of or eaten at a McDonald's. So McDonald's is actually fairly saturated, so you're probably wondering why it's even on this list. Well, actually, to be honest with you, all the reports that I've been reading, analysts are actually projecting a slight decline in revenues for the current fiscal year. So again, why is it on this list of 3 stocks to buy in March? McDonald's is actually going back to a straight up franchise royalty model. So as you know, McDonald's are franchises, but some of them are actually owned by corporate. They're actually trying to get every restaurant under a franchise model, which is really lucrative in terms of royalties and fees. So the franchise model have very few associated costs, and that's in large part why, even though McDonald's simply doesn't have much more room for expansion, analysts expect profits to grow more than 14% in 2018. McDonald's is what we call a dividend aristocrat, and if you don't know that term, please Google it. That's dividend aristocrat, and I'll leave that in the description below so you know how to Google it if you're not sure how to spell that. But it's essentially shown consistent dividend growth for a number of years in a row. So McDonald's has paid out higher distributions each year for more than 4 decades, which means yield on cost keeps getting better for anyone holding shares. And again, that's another reason why it's on this list. So this yield is also on the low side right now, partly because of a 25% jump in shares over the past year. So this may not be the best pick in terms of capital appreciation in the share price, but this is definitely a great dividend play for the long term. So Bank of America and Merrill Lynch analysts suggest that McDonald's shares have appeal as a total return, meaning dividends and possibly some share appreciation over the long term. So the dividend right now is 2.48%, and the 1-year ROI of McDonald's has been an excellent 26.7%. So there you have it. Those are my 3 stocks to buy in March of 2018, and you may have noticed a common trend. These 3 stocks I picked not only because I'm bullish on them, but also because they show strong yields and a strong history of dividend increases. So we may be up for a rocky ride in terms of market appreciation over the next year or so, and I think these are some pretty good defensive stocks to have in your portfolio. So if you got any value from this video whatsoever, please leave a like, please comment, and please subscribe. I would really appreciate it. And most importantly, share this video with one friend. Thank you so much and have a prosperous day. Ba-da-ba-ba-ba, I'm getting fat. No, that's not how it goes.